Hello, my name is Angela Frey, and this is a strategic analysis on Southwest Airlines. Southwest Airlines was started in Texas in 1971 as a low-cost carrier focusing on offering high-quality customer service. The company functions with a mission of dedication to the highest quality of customer service, delivered with a sense of warmth, friendliness, individual pride, and company spirit. In addition to its mission, Southwest follows the broad yet descriptive vision of becoming the world's most loved, most flown, and most profitable airline, and values include determination, serving others, embracing fun, safety and reliability, friendly customer service, and low cost. These statements combine to show that Southwest aims to provide top-quality customer service experiences and offer low prices while maintaining the integrity of the company. Southwest's strategy focuses on creating a balance between its stakeholders while continuing its strategic goals by emphasizing sustainability, profitability, conservation of natural resources, innovation in the workplace, and sustaining the communities in which it operates. To execute this strategy, Southwest stresses its route options, strong brand recognition, and successful financial performance. Southwest flies short flights with frequent departures based on a spiderweb model and uses only a single model of plane in its fleet, allowing the company to cut down turnaround time at its stops. By providing numerous short flights throughout the country, Southwest was able to fly the most customers in the year ending June 30, 2018, with the most takeoffs worldwide. Southwest's brand recognition and service culture provide customers with positive experiences and builds brand loyalty. Southwest reaches its financial goals by reporting 46 consecutive years of profits and achieving a competitive advantage based on low costs. These aspects show that the combination of Southwest's focus on its route, brand image, and financial performance allow the company to achieve each aspect of its mission, vision, and values in a way that any single course of action would not be able. This analysis shows an unstable United States political environment that has seen restrictions on immigration into the country, slowed economic growth, and damaged political relations. This presents an uncertain future for airlines looking to expand internationally and risks lower passenger numbers. The U.S. economy shows rising interest rates and plateauing disposable income, which could cause airlines to see drops in sales as people choose cheaper ways of travel or choose not to travel at all. Sociocultural trends in the United States show rising numbers of millennials, increased leisure travel, and focus on environmental protection. With millennials having thousands of dollars in debt and leisure travelers spending less on trips, airlines are being pushed to lower prices while being environmentally conscious. Technological changes in the airline industry include increasing use of biometrics and robots in handling baggage, delivering information, and checking in passengers. Airlines cause environmental harm in the form of carbon emissions and noise. While there's not much that airlines can do about the noise, they can take steps to reduce their carbon footprint. Current legislation imposes regulations for flight attendant breaks and seat size requirements. The standard duration of breaks risks increasing turnaround times, while mandating seats to be a certain size limits the potential for profits in seating. Overall, the PESTEL analysis finds the airline industry to be moderately attractive at best due to the changing nature of the various elements. Reporter's five forces, buyer power in the industry is high, as there are low switching costs for choosing one airline over another, many customers are cost-driven, and there are numerous airlines to choose from. The supplier power is moderate to low, with most airplanes being made by Boeing or Airbus, giving airlines few options. However, the limited number of airlines buying planes encourages sellers to charge reasonable prices. With cities seeing 2.5 times as much competition over the past 20 years, rivalry has a high impact on the airline industry. This is leading to airlines trying to take over others' hubs and gates locations at airports, as well as pressuring airlines to offer lower prices. With the main substitutes for air travel being ground travel, the impact of substitutes is low. Only short-haul flights can successfully and economically be completed by ground transportation, and cross-country or international travel becomes inefficient or impossible with those methods. Entry barriers for the industry are high, as planes are expensive, between $11 million and $320 million. The high competition to acquire spaces at gates and the shortage of pilots makes it unlikely that those that enter the market will be able to acquire the needed resources to succeed. Overall, the airline industry is attractive for existing companies and unattractive for potential new entrants. Southwest has strengths in its low-cost strategy and customer service skills. The low cost gives an advantage as buyers push for lower prices, and customer service plays a key role in ensuring positive passenger experiences. Southwest's weaknesses stem from a lack of differentiation and its limited offering of short-haul flights. The company does well with low prices and customer service, but doesn't have much else to make the company stand out from competitors. Only offering short flights means customers can only turn to Southwest for select destinations. Southwest sees opportunities with the rise of budget travel and international travel, specifically to Africa and the Asian Pacific region. With a low-cost structure, Southwest is positioned well to offer low prices and gain customers. Increasing international travel gives Southwest the chance to expand its offerings abroad. Threats are seen in the increased competition based on price and the new legislation regarding airlines. As competitors lower prices, Southwest's advantage of offering low prices becomes less effective. New legislation regarding seat sizes and flight attendant breaks could hurt Southwest's quick turnaround times and the number of flights they're able to offer. Overall, the SWOT analysis shows Southwest will see threats and has weaknesses, but its strengths provide potential to seize new opportunities. RIO analysis shows that Southwest's product is valuable for customers seeking airline flights for low prices, but is not rare as there are 59 airlines in the United States alone. Airplane flights are not inimitable as seen by this number of airlines. However, Southwest is organized well to gain a profit from its flights, as the functional structure allows for specialization in its various departments, and centralized decision-making stays in line with the company's strategy. Overall, the company is mildly successful in regards to the VRIO framework. Financially, Southwest is doing quite well, and in 2018 was tied for the highest market share in the industry, making Southwest on track to be the highest flown airline. Southwest saw rising revenues and decreasing cost of goods sold between 2013 and 2017, as well as increased gross profit margins, net income, and total assets. With increasing revenue and declining expenses, Southwest is doing well to make a profit on its investments. According to D&B Hoovers, American Airlines, Delta Airlines, and JetBlue are Southwest's main competitors. When compared to these competitors, Southwest sees lower revenue than American Airlines and Delta, but shows a higher gross profit margin than both companies, showing a strong ability to make a profit after covering expenses. Southwest, Delta, and JetBlue all make higher returns on investments than American Airlines, which shows that simply making higher revenue in this industry does not mean a company is going to make a high return on what it spends. While JetBlue has lower revenue and market share, it becomes a formidable opponent when considering the company's gross and net profit margins and return on investment. This, along with JetBlue's similar offerings to Southwest, shows that Southwest must not only watch out for large established companies like American Airlines and Delta, but for underdogs like JetBlue as well. Southwest pursues a low-cost strategy by decreasing expenses throughout its value chain. Southwest cuts costs by not offering in-air meals, using fast turnaround times to have fewer planes fly more routes, flying limited distances, and avoiding major airports. Southwest furthers its efforts to achieve its strategy by using a fleet of only Boeing 737 planes that provide more seats, which allows Southwest to earn higher profits on each flight. These choices allow Southwest to avoid the cost on segments everywhere from check-in to baggage pickup. However, this may not be a sustainable competitive advantage. With airlines being pushed to offer lower prices, Southwest will have to find ways to be both low cost and differentiated. Southwest could develop a stronger sustainable competitive advantage by emphasizing its devotion to customer service. Southwest diversifies by adding new routes and destinations, having expanded to 40 of the 50 United States, with routes to Hawaii expected to pass testing soon. Southwest also offers select routes to countries close to the southern border of the United States. Southwest has proven from both its first-place market share and its successful financial performance that the strategy works well for the company, as Southwest has been able to expand to popular cities by using secondary airports. Until now, Southwest has expanded to countries in close proximity to the United States, likely because it did not previously have approval to fly overseas. However, adding Hawaii as a destination is gaining Southwest that approval, which could allow Southwest to add more international destinations. This lack of international exposure gives Southwest little competitive advantage in international markets, but the company has a potential to build this presence with the approval of overseas flights. However, this will require Southwest to develop the necessary core competencies for longer flights. Southwest has a mechanistic functional structure. The company is broken down into progressive levels of management, with managers held responsible for specific functional segments. With a low-cost model and widespread organizational functions, this structure works well for Southwest by allowing it to specialize in its various departments while working among different departments for overall company success. This gives the CEO centralized decision-making power with input from various functional groups. The structure allows for a clear line of reporting, but limits Southwest's ability to make decisions quickly as higher management decisions take time to reach all departments. Southwest key leader Gary Kelly, chairman and CEO of Southwest, has spent over 30 years at Southwest, making his way up to chief executive officer. Kelly exemplifies the Southwest culture and acts as a role model by engaging with employees, knowing them by name, and making people feel welcome and part of the team. This keeps employees motivated towards reaching the company's vision and goals effectively, as Kelly has been CEO for 15 years and the company has successfully grown over that time. Southwest's hiring process focuses on finding people who match the company culture and show a warrior spirit, servant's heart, and fun-loving attitude. The company receives hundreds of thousands of applicants a year and often interviews over 100 candidates for a position, showing a dedication to finding the right person to fill each role. Southwest pursues corporate social responsibility through a triple bottom line that emphasizes performance, people, and planet. Southwest meets its performance goal by being ranked #1 in customer service by the U.S. Department of Transportation, giving back nearly $2 billion to its shareholders, and having over 40 years of recorded profits. The people involved with Southwest have seen over $37 billion in donations, and employees earn hundreds of millions of dollars in profit sharing each year. Southwest's Code of Ethics states Southwest operates with common sense, good judgment, and safety while bringing profits to shareholders. Southwest restricts insider trading, price fixing, paying off government employees, sharing proprietary information, and falsifying accounting records. This shows that Southwest's Code of Ethics not only holds its employee accountable, but that the company is devoted to doing what is right for not only itself, but for everyone affected by its actions. Southwest promotes sustainability with a 29% increase in fuel efficiency between 2005 and 2016, switching from using printed papers to tablets to handle their operational materials and recycling materials used in flight, saving nearly 3,800 pounds of waste from going to landfills in 2017 alone. Southwest saved 8.5 million gallons of fuel in 2017 and is switching many of its on-ground vehicles that work on with plane preparation to electric vehicles. While these switches may be more expensive than alternatives, they help Southwest portray a positive brand image that allows Southwest to not only profit and prosper, but to be a force of good in its communities. Southwest Airlines has strong financial performance, a winning low-cost strategy, and an unparalleled focus on customer service, all of which make it successful as a low-cost airline. However, Southwest struggles due to a lack of differentiation outside of a low-cost structure and a limited number of routes that restrict the number of potential passengers Southwest can attract. Southwest has proven that it can execute its low-cost model and be successful, but as competitors are being pushed to offer lower fares, Southwest becomes just another airline. While Southwest has quality customer service as the company's defining feature, that competency is not rare or complex and can be easily imitated by competitors. This puts Southwest in a difficult position as customers have more low-price options and Southwest doesn't differentiate itself. This issue is worsened by Southwest's limited number of routes. The airline is primarily a domestic U.S. carrier, but flies to only 40 of the 50 United States and a handful of other surrounding countries. Meanwhile, American Airlines and Delta have extensive offerings in the United States and abroad, giving Southwest's competitors a wider customer appeal. This, along with Southwest's lack of differentiation beyond low cost, puts Southwest at a disadvantage and poses a strategic issue as to how the company can attract and retain passengers. To combat this lack of differentiation, Southwest can expand its destination offerings while emphasizing its customer service. Southwest can increase its destinations to reach Montana, North Dakota, Africa, and the Asia-Pacific region. Montana saw almost 3.9 million flight passengers in 2016, a record for the state, and is expected to keep this increased demand. North Dakota had 2.2 million people going to or from the state in 2017. The trend of rising airplane passengers in these states makes them worthwhile options for Southwest. Africa and the Asia-Pacific region were projected to have the highest growth in international arrivals, making them viable locations. The recent approval to fly overseas gives Southwest the opportunity to pursue more international locations. When coupled with the current and projected increase in international travel, adding international routes provides a viable option for new profits for Southwest. However, in pursuing international destinations, Southwest must seriously consider the changing political status in the United States has with other countries, as this could present issues for Southwest if relations between the countries deteriorate. To achieve these expansions, Southwest will need to develop competencies in entering new markets, understanding travel patterns and cultures of different countries, and performing long-distance flights. Southwest has grown into a thriving low-cost carrier with strengths in a low-cost model and dedication to customer service. In a moderately attractive and highly competitive market, Southwest diversifies by adding new destinations and routes and maintains its brand image by hiring the right people. However, Southwest is faced with a lack of differentiation beyond a low-cost strategy and focus on customer service. To help combat this, Southwest can add destinations in Montana, North Dakota, Africa, and the Asia-Pacific region. These changes will take time, effort, and money to complete, but Southwest did not claw its way to the top of the market share position by avoiding change and uncertainty. The company faces industry struggles and competition, but has the core competencies, financial prowess, and desire to share the Southwest love that will allow it to challenge the competition, expand its destinations, and grow as a customer favorite. The following slides show the references used in the making of this strategic analysis. Thank you for watching.